All right, let's dive right in. Today we're taking a close look at Parkway Life REIT's latest full-year results. We're going to unpack this from an investor's point of view and really get into what's making them tick.
So this is the million-dollar question, right? In a market that's, well, pretty shaky, how do you actually find some stability? Where are those steady returns hiding? Turns out companies like this one might just hold some of the answers.
And boom, here's the headline number for Parkway Life REIT, or P-Life REIT, as you'll often hear it called. A 2.5% jump in their distribution per unit for the full fiscal year. That is a solid, steady increase, exactly what investors like to see.
Exactly. And let's quickly break that down. DPU, distribution per unit, is basically the bottom line for anyone investing in a REIT, a real estate investment trust. It's not some abstract profit figure. It's the actual cash that lands in your pocket for every unit you own. So yeah, when you see that number climbing, that's a very good thing. Okay, so a nice steady increase. But how they pull it off? Well, it's not luck. It all comes down to the foundation of their business, which is what you'd call a defensive healthcare portfolio. Let's get into what that really means. So, take a look at this. We're talking about a portfolio of 74 properties. But it's not just a bunch of buildings. These are crucial healthcare assets, hospitals, nursing homes, spread across Singapore, Japan, and even France. And the whole shebang? It's valued at a hefty 2.57 billion Singapore dollars. That's some serious real estate. Okay, but what makes this portfolio defensive? This is the really clever part. First off, you've got these super long leases. I mean, the ones in Singapore are locked in until at least 2042. That's predictable cash flow for decades. Then, get this, nearly 70% of their rent is tied to inflation. So as costs go up, so does their income. It's a built-in shield. And finally, think about it. People always need healthcare, right? Especially with aging populations. That demand isn't going anywhere no matter what the economy does. Having great properties is like having a great engine. But you also need a strong chassis to handle the bumps in the road. And right now, the big bumps are interest rates. So that brings us to P-Life REIT's financial shield, how they're built to withstand those storms. All right, let's pop the hood and look at the numbers. Their gearing, which is just a fancy word for their debt level, is at a really comfortable 33.4%. Their interest coverage is a whopping 8.6 times. And they've been smart. They've hedged about 93% of their debt against rate hikes. And maybe the most impressive number? Their average cost of debt is super low, just 1.59%.
So let's put that gearing number into perspective. 33.4%. Why is that good? Well, it's kind of like having a really small mortgage on a valuable house. It means you're not drowning in debt, and more importantly, you have plenty of room to borrow more if a great opportunity comes along. It gives them flexibility. And what about that 8.6 times interest coverage? That's your safety net right there. It literally means that for every dollar they owe in interest, they're earning $8.60 to cover it. It's a huge cushion. So even if profits take a bit of a hit, there's no danger of them not being able to pay their bills or, pay their investors. Okay, so we've established they're stable, they're secure, they've got that financial shield up. But that's just defense. The big question for any investor is, what's the plan for growth? Where do they go from here? Let's look at their playbook. And it's a pretty straightforward three-part plan. Pillar 1, stick to what you know. They're going to keep investing in the markets they're already in with partners they trust. Pillar 2 is asset recycling. Think of it like trading up. Sell a mature property that's not growing much anymore and use that cash to buy something new with more upside. And Pillar 3 is just smart management, squeezing more value and revenue out of the buildings they already own. It's a solid, balanced game plan. All right, so let's zoom back out. We've looked at the portfolio, the financials, the growth plan. What's the big takeaway for an investor looking at all this? Sometimes the person in charge says it best. The CEO, Mr. Young Yan Chow, basically summed it all up. He talks about the resilience of their portfolio and says they're in a great spot to chase after disciplined, yield-accretive growth, while still delivering those stable and sustainable returns. That's pretty much the mission statement right there. So let's just boil it down to the essentials. 1, that consistent DPU growth, it's real and it shows stability. 2, their healthcare assets are defensive, which means a reliable stream of income. 3, their balance sheet is a fortress, low debt, financially shielded. And 4, they have a clear 3-pillar strategy for what's next. It's the whole package, really. Stability now with a plan for growth later. And that kind of leaves us with one big question to chew on. You look at today's world with all its ups and downs, and you have to wonder, is tying your investment to something as essential as healthcare, is that the ultimate defensive move for your portfolio? Definitely something to think about.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events, and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.